How liquidity lost its nerve. For years, liquidity was treated as a constant, always present, always responsive, an invisible force that absorbed shocks and smoothed uncertainty without asking questions. Then, almost imperceptibly, it stopped behaving that way. To understand why this matters now, we need to revisit a time when markets trusted liquidity more than fundamentals. Depth was assumed. Tight spreads were expected. If something went wrong, capital would appear to correct it. That belief shaped strategy, risk-taking, and confidence itself. Liquidity isn't just volume. It's willingness. It's the readiness of participants to commit capital without hesitation. And for a long time, that willingness felt automatic. When prices dipped, buyers appeared. When volatility spiked, markets adjusted. The system felt resilient because liquidity felt fearless. The first reveal begins with a subtle behavioral change. Liquidity providers didn't disappear. They stayed visible. Quotes were still there, but size shrank. Commitment shortened. Capital was offered, then quickly withdrawn. Liquidity became tentative. The second reveal emerged during routine stress. Small imbalances took longer to resolve. Price discovery slowed. Depth that once absorbed pressure now stepped aside after initial contact. Liquidity wasn't failing. It was flinching. The third reveal came when experienced traders noticed something unsettling. Liquidity no longer led the market. It followed it. Instead of stabilizing moves, it waited for confirmation. It responded after direction was clear, not before. That delay changed everything. Because markets don't rely on liquidity being abundant. They rely on it being brave. The moment liquidity hesitates, risk behaves differently. Strategies built on smooth execution struggle. Volatility becomes uneven. Confidence fades not because prices fall, but because support no longer feels unconditional. Liquidity hadn't vanished. It had lost its nerve. And once that happens, markets begin operating under a new rule set, one where every move carries more weight, every pause feels heavier, and every test matters more than the last. What followed would show that when liquidity stops believing in the market starts questioning itself. And that question rarely ends quietly. As liquidity grew cautious, the market didn't react immediately. Prices continued to move. Trades still cleared. From a distance, everything looked functional. But functionality isn't the same as confidence. And confidence was quietly eroding where it mattered most. The conflict emerged in how liquidity responded to pressure. In the past, small sell-offs invited firm bids. Capital stepped in early, absorbing imbalance before it could grow. Now, bids appeared later and in smaller size. Liquidity waited to see how others would act before committing. That hesitation allowed moves to extend further than expected. Market makers felt the change first. They adjusted spreads incrementally, not to signal fear, but to protect against uncertainty. Quotes became more conditional. Depth thinned near key levels. Liquidity was still offered, but only briefly and only with an exit ready. The market learned that support was no longer guaranteed. The tension deepened as this behavior repeated. Each minor disruption reinforced the same pattern. Initial selling wasn't met with immediate resistance. Instead, prices searched for balance longer. That search created discomfort, and discomfort altered behavior. Traders who once acted decisively began waiting. Waiting reduced depth. Reduced depth amplified movement. Derivatives markets reflected the shift in a subtle way. Hedging demand increased during calm periods, not volatile ones. Participants weren't afraid of collapse. They were unsure of response. Protection wasn't about disaster. It was about hesitation. Liquidity risk had replaced price risk. The buildup accelerated when leverage strategies adjusted, not because limits were breached, but because execution assumptions changed. Strategies built on fast absorption now faced delay. Slippage increased. Risk models still showed stability, but behavior told a different story. The system had become sensitive to timing. Veteran participants recognized the danger. Liquidity doesn't need to disappear to destabilize markets. It only needs to hesitate. When capital waits collectively, even modest pressure can travel farther than expected. Balance still exists, but arrives late. As days passed, This new dynamic became the norm. Support appeared, but only after movement. Recovery happened, but unevenly. Liquidity had stopped leading the market and started reacting to it. That reversal quietly rewrote how risk was priced. The market was still liquid, but liquidity was no longer confident. And a market supported by cautious liquidity behaves very differently when stress finally arrives. Because when the system relies on capital that waits to see what happens, the first move always matters more than it should. And the next test would reveal just how much nerve liquidity had already lost. The next test didn't need to be dramatic. It only needed to arrive. A modest surge in selling pressure appeared. Nothing unusual by historical standards. In previous cycles, this kind of imbalance would have been absorbed almost automatically. This time, it lingered. Liquidity showed up, but cautiously. Bids flashed, then disappeared. Depth appeared momentarily, then stepped aside. The market probed for support and found hesitation instead of resistance. Prices moved further than anyone expected, not because sellers were aggressive, but because buyers were unwilling to commit early. The conflict intensified as this pattern repeated across assets. What began as a localized imbalance spread unevenly. Correlations tightened without announcement. Instruments that once stabilized each other now reacted together, amplifying movement rather than absorbing it. Liquidity's hesitation had become contagious. Execution desks felt the pressure immediately. Orders required more patience. Slippage widened. Timing became critical in ways it hadn't been before. Strategies built on speed struggled in an environment where capital waited for confirmation. The cost of acting first had risen sharply. The buildup accelerated as leverage participants adjusted. Risk controls weren't triggered by losses, but by uncertainty. Exposure was trimmed incrementally, not in panic, but in preparation. Those reductions removed even more depth from the system, reinforcing liquidity's caution. Veteran traders recognize the feedback loop forming. Liquidity hesitates. Movement extends. Extended movement increases caution. Caution reduces liquidity further. The cycle doesn't require fear. It feeds on doubt. And doubt had already taken root. The tension peaked when a familiar level, one the market had defended countless times, failed without a fight, not because sellers overwhelmed it, but because support never truly arrived. Liquidity watched the level break, then followed the move instead of opposing it. That moment clarified everything. Liquidity hadn't lost capacity. It had lost conviction. And conviction is what transforms capital from reactive to stabilizing. Without it, liquidity becomes opportunistic rather than supportive. It waits for direction instead of creating balance. As the market absorbed the move, volatility rose unevenly, not explosive but persistent. Recoveries were slower. Confidence didn't snap back. Participants began questioning assumptions they hadn't revisited in years. Was liquidity still reliable, or had it become conditional? The answer was now visible in behavior. Liquidity still existed, but it no longer believed in defending the market. And once that belief disappears, every future test becomes more dangerous than the last. Because a market can survive selling, it struggles to survive hesitation. The final phase would reveal what happens when the pressure didn't arrive all at once. It accumulated. Each hesitant response made the next move heavier. Each delayed bid taught participants that waiting carried less risk than acting. Liquidity, once the market's quiet backbone, had become a spectator. That was the climax. Not a collapse, but a revelation. The market wasn't breaking because capital had vanished. It was breaking because capital no longer felt responsible for holding it together. Liquidity had shifted from stabilizer to opportunist, stepping in only after direction was clear. As prices adjusted, the pattern repeated itself across sessions. Initial moves extended further than expected. Recoveries arrived late and uneven. Volatility lingered. Nothing felt out of control, yet nothing felt supported. The market had entered a state where every move needed to prove itself before liquidity would engage. Explanations followed, as they always do. Some blamed sentiment, others blamed positioning, a few blamed technology. But those narratives missed the core truth. Liquidity hadn't failed mechanically. It had changed psychologically. The resolution emerged slowly, participants adapted. Strategies were restructured around delayed support instead of immediate absorption. Risk models were adjusted to reflect timing, not just size. The market found a new equilibrium, less fluid, more cautious, and far more sensitive to early moves. What lingered was a lesson. Liquidity isn't just about availability. It's about confidence, about belief in the system it supports. When that belief weakens, liquidity becomes conditional, and conditional liquidity rewrites how markets behave under stress. Liquidity didn't disappear. It lost its nerve. And once nerve is gone, markets no longer glide through uncertainty. They stumble through it, one hesitant step at a time. Understanding this moment matters because it explains why future shocks feel sharper, why recoveries feel slower, and why stability now depends on patience instead of trust. The quiet truth is this: markets don't change when liquidity dries up. They change when liquidity stops believing it should step in first. So what do you think? Has liquidity regained its nerve? Or are we still trading in a market that waits to see what breaks before it acts? How